Welcome to this Killik Explains finance video. This week, the difference between risk and volatility, two terms that are often confused by investors to their cost. Now, who better to ask about this than Warren Buffett, the legendary US investor, arguably the most successful long-term investor on the planet. He has said three interesting things. One, if the investor fears price volatility, erroneously viewing it as a measure of risk, which he says it isn't, he may, ironically, end up doing some very risky things. I'll explain these comments in just one moment. Number two, investors can make stock ownership risky through their own behavior. So it's not about the asset class itself, it's more about the way you treat it. And number three, risk essentially comes from not knowing what you're doing. So risk comes from applying the wrong approach to an asset class, not necessarily the asset class itself. Now, in summary, what do we mean therefore by risk as opposed to volatility? Why are they not the same thing? Well, essentially, risk, if you're a long-term investor, is the destruction of your ability to buy stuff. It's the erosion of your purchasing power. More about that in a moment. Volatility, on the other hand, is the fact that some asset classes experience short-term ups and downs, and some of those can be quite extreme. All right, cash generally doesn't, but shares do. But the point is, that doesn't mean that cash is a low-risk asset. Why not? Because, in a nutshell, if we were to look at the purchasing power of £100 from the early 1970s all the way through to nearer today, you can see that because of inflation, the value of that pound is being destroyed, or the value of that £100 is being destroyed. All right, to give it sort of some practical impact, a sliced loaf, according to the government in 1985, would have cost you about 37p. So a pound would have bought you more or less three of them. Now, £1.30. So a pound, same pound, looks like the same pound, won't even buy you one. You get the idea. Carrots, similar idea, although inflation is not quite as extreme. Diesel per litre, again, you could have got 3 litres back in 1985, 2/3 of a litre now, and then a pint of lager, topic close to my heart, 73p then, £3.35p now. You get the idea. Cash looks safe because it doesn't move around much, but its value erodes over time because of inflation. Now, what, therefore, is better at preserving its value over the long term, provided it's managed correctly? Now, the past is no guarantee of the future, but between 1965 and 2015, handled correctly, the Barclays Equity Gilt Study of 2015 reckons this. Your average annualized return from shares, in real terms, is not shy, or just slightly shy of 6%, compared to, this is a point I've made before, below 3 for government IOUs, and just above 1 for cash. All right, now, if you're thinking, well, I don't get those sort of returns from shares, that could be to do with the way you behave. Remember that comment from Buffett about risky behavior. So, are shares actually risky? Well, according to that, they suddenly don't look too risky. And we can see this another way. Over the long term, if we were to compare the FTSE All-Share, inflation adjusted, to cash, inflation adjusted, and we were to track back to the early 1970s and then roll forward to now, how would it look? In other words, if I put £1 to work in at the start, and my choices are the FTSE All-Share inflation adjusted or cash inflation adjusted, here's where I end up. The real value, if you like, of my pound in cash is only 9p because of the effect of inflation, whereas the equivalent investment in shares is worth more like £1.70. And that means, line at the bottom, that basically the purchasing power of your equity investment is around 19 times that of cash, comparing the two now. And that's the bit that's important. That makes cash riskier than shares, seen through that prism of purchasing power protection. Now, what can go wrong, therefore? Well, Warren Buffett alluded to the idea that investors are their own worst enemy. Risky behavior. So, if you're in a volatile asset class, panic selling is a really bad idea. And there are a couple of instances, even this year, of where people might have done that. In February, the doomsters were saying, get out of shares, pile into cash. And then around the referendum. And that, as I make this video, looks like a bit of an error. Panic selling, following the newspapers, bailing out at the wrong time. And then forced selling. That's something you can definitely plan for. It's the idea that you set aside a rainy day fund, to cover emergencies, for example. It's the idea that you plan for when you'll need to pull money out of shares, so you're not doing it helter-skelter, scrambling at the last minute, liquidating shares at just the wrong point. And that reduces the risk. You will liquidate shares at just the wrong moment. So that's what I mean by, and this is very light, I've covered it in more detail in other videos, investor behavior being often the enemy of somebody trying to preserve their purchasing power over time. There you have it. Risk and volatility, not quite the same thing. Any questions? editor@killik.com. And to see other videos on this topic and some videos that expand on some of the points I made in that video, please go to our comprehensive library, of which this is a part, at killikexplains.com.